Your retirement might be losing purchasing power without making a sound. And the worst part, it's happening slowly enough that no one panics fast enough to catch you off guard. In the first half of 2025, the dollar fell close to 11%. This isn't just currency movement, it's confidence. When the center of the system loses credibility, everyone pays the price at the grocery store. In financing, in retirement, I'm going to show you the mechanism. That's why when the dollar wobbles, capital seeks safety and protection assets come onto the radar. If you observe financial markets carefully over recent months, you'll notice something fundamental has changed. This isn't just a temporary correction or short-term adjustment. It's a structural shift reflecting much larger forces in motion. For those living in the United States and keeping their savings in dollars, this moment represents more than numbers floating on a screen. It represents a silent but profound transformation in the global economic order that has sustained our prosperity for decades. History has always taught me one thing, and it's showing me patterns I've seen before. Let me take you through a lesson I learned studying 5 centuries of economic history. Empires and their currencies follow predictable cycles. Over the past 500 years, I've observed a clear sequence. The Dutch Empire dominated the 17th century. The British Empire controlled the 18th and 19th centuries. And the United States took leadership in the 20th century, especially after World War II. Each of these empires had its currency as the global reserve currency. The Dutch guilder, then the British pound, and finally the American dollar. And each transition followed a similar pattern. First, the country develops military and economic superiority. Then, its currency becomes the preferred medium of international exchange. For decades, this creates an extraordinary virtuous cycle. The world demands your currency, so you can print it to finance your growth in military power, which keeps the world demanding your currency. But then, inevitably, the decline phase begins. The country starts spending more than it produces, debt accumulates, relative productivity declines. Other countries begin questioning why they should finance the global hegemon's lifestyle. And gradually, very gradually at first, they begin diversifying into other currencies and assets. This process doesn't happen overnight. It takes decades. But when you see the signs, they're unmistakable. And today, in 2025, these signs are everywhere. Dollar participation in official reserves has been gradually declining over decades. According to COFR, IMF data not accelerating dramatically, but in a clear trend. It seems small, but when you're talking about trillions of dollars, these percentages represent massive changes in global capital flows. European investors, who traditionally held large positions in U.S. assets without currency protection, are now adding currency hedges against the dollar at record levels. This means they are reducing dollar exposure. And when the world hedges the dollar, it's saying, I don't trust this will remain stable. Central banks continue increasing gold as a diversifier. China, India, Turkey, all building gold reserves and in some cases more commodity exposure at an elevated and consistent pace in recent years. This isn't coincidence. It's deliberate diversification, moving away from total dollar dependence. I see the incentives and I understand the behavior. And today's incentives clearly point to a world that is silently moving away from total dependence on the American dollar. And this is where your life enters the chart. Where does this leave your money? To truly understand what's happening with the dollar, you need to grasp 3 fundamental principles that govern all reserve currencies. The first principle is fiscal credibility. A global reserve currency needs confidence in the issuing country's ability to honor its debts, not just today, but for decades into the future. Look where we are today. U.S. federal debt now consumes a growing percentage of all tax revenues just in interest payments. In 2025, by the latest data, we're paying a significant slice of all federal revenues just on debt interest. This is mathematically unsustainable. It's not a political opinion, it's basic arithmetic. When you combine this with the fact that projected deficits continue growing as a percentage of GDP, you're looking at a trajectory that questions fundamental fiscal sustainability. In 2025, Moody's downgraded the U.S. from AA to AA1, the last of the major agencies to do so, after S&P 2011 and Fitch 2023. This isn't just symbolic, it's a signal to global investors that American credit risk is increasing. The second fundamental principle is political and monetary stability. Global investors need confidence that monetary policy will be conducted predictably and independently without excessive political interference. In 2025, monetary policy became a public dispute. External pressure plus internal divergences increased the sense of unpredictability. This political instability has direct consequences in currency markets. When investors question central bank independence, they question currency credibility. The point isn't the exact number of cuts, it's the message. When the market perceives institutional pressure and noise, it prices in risk. This internal division reflects pressure between two conflicting mandates: controlling inflation, which still remains above target, and supporting a labor market showing signs of weakening. When the central bank faces political pressures and internal division simultaneously, confidence in the currency suffers. You see the pattern? It's not about politics. It's about mathematics. And mathematics doesn't lie. And this brings us to the third principle, relative investment attractiveness. A reserve currency needs to consistently attract global capital. Investors need to want to hold assets in that currency. Here are the signals I see in 2025. Global flows began seeking more diversification outside the U.S., a clear behavioral shift. Simultaneously, currency hedges grew among foreign investors. Investors are literally protecting themselves against dollar currency risk. This isn't a short-term trend. It's a rearrangement in the risk-return perception of American versus global assets. And observe this crucial point. In the first 6 months of 2025, while the dollar was falling, international assets had much superior performance to American assets for dollar-denominated investors. For global investors, holding dollars became a source of losses, not gains. Now, imagine a country that, for decades, was dependent on the American economy. Germany always maintained a close economic relationship with the United States. German companies invested heavily in American assets. The German government held substantial reserves in dollars and U.S. Treasury securities. But in 2025, something fundamentally changed in the German conversation. In Europe, the conversation became autonomy, more domestic investment, more defense, less dependence on a single center. And this type of change alters flows, hedging, and allocation. When Europe's largest economy takes this direction, other countries observe and often follow. And while this happens out there, your bank account here is losing purchasing power. Now imagine the same pattern repeating across dozens of countries. When even traditional buyers become more sensitive to currency, the system's floor changes. Central banks around the world, Brazil, India, Russia, China, even European countries, are discreetly reducing their dollar exposures and increasing their reserves in gold, euros, and other currencies. Each individual movement may seem small, but when you add up all these movements, you're seeing a redistribution of confidence in global capital flows. It's like a dam with small leaks. One leak doesn't bring anything down. But when there are many, simultaneously, the entire structure starts working at its limit. And the market doesn't wait for the dam to burst to act. It acts when it perceives the pressure has changed. But this is other people's problem, right? Wrong. Now comes the practical part, the impact on your life. If you're 45, you're 15 to 20 years away from converting work into income. The risk isn't going broke. It's arriving there with money, buying less than you imagine. First, let's talk about cost of living. A weaker dollar means everything we import becomes more expensive. And we import much more than most people realize. Not just obvious products like electronics, clothes, and cars, but also components for practically everything we buy. When the dollar fell 11%, in the first half, the cost of these imported goods rose proportionally. This is direct inflation, hitting your family budget directly. And here's the complicated part. The government has responded to this inflationary pressure with even higher tariffs on imported products. This creates a situation where you as a consumer pay twice, once for the weaker currency, another time for higher tariffs. For a middle class family, this can easily mean thousands of additional dollars in annual costs, especially when weak currency and tariffs stack costs. Second, let's consider your savings and investments. If you have your entire retirement in dollar-denominated assets, checking accounts, savings accounts, CDs, U.S. bonds, you're essentially betting everything on the continuation of dollar strength. This might be correct in the long term. The dollar is still the global reserve currency, and there's no obvious and immediate substitute, but it might also be wrong. And if it's wrong, the cost will be high. Consider this scenario. You have $500,000 saved for retirement, all in dollar-denominated assets. If the dollar continues losing international value at a rate of 8 to 10% annually for the next 5 years, the global purchasing power of these savings will have diminished significantly. This doesn't mean you'll become poor. It means your ability to maintain a standard of living that depends on global goods and services, international travel, imported products, even digital services from foreign companies will be compromised. Third, there's the issue of energy and food security. The United States is still relatively self-sufficient in energy and food, but even here, there are significant global dependencies. Fertilizers, agricultural equipment, energy infrastructure components, many come from abroad. A permanently weaker dollar makes these inputs more expensive, which eventually translates into higher energy and food costs for you. For a typical American family, a 20-30% weaker dollar over 5 years can easily mean a 25% increase in total cost of living, even maintaining the same consumption pattern. Based on the principles I see governing these long-term cycles, I'll share practical strategies that can help you protect and position your wealth for this new reality. The first guidance is intelligent geographic diversification. If everything you have depends on the dollar, you're not diversified, you're concentrated. And concentration is exposure. This means maintaining exposure to assets outside the US dollar system, not necessarily as a bet against the United States, but as protection against excessive concentration risk. Consider allocating between 20% and 40% of your portfolio to international assets. This can include foreign company stocks, government bonds from countries with superior fiscal discipline, and funds investing in emerging economies with high growth. The crucial point is understanding that you're not betting against the United States. You're protecting yourself against the risk that the United States, however good its domestic fundamentals, might lose relative competitiveness in the global scenario. The second guidance involves real assets as protection. Paper money can be printed. Gold cannot. Real estate cannot. Commodities cannot. This protects. Cash sitting still exposes. Gold obviously falls into this category, not through mysticism, but through simple mathematics. When central banks around the world are buying gold at record volumes, they're effectively signaling lost confidence in the current monetary system's sustainability. But beyond gold, consider other real assets. Real estate in markets with solid structural demand, strategic commodities, stocks of companies with tangible assets and ability to pass through cost increases. The key is understanding you're buying protection against monetary devaluation, not speculating on future prices. The third guidance focuses on income in strong currencies. If possible, consider ways to generate income in currencies showing superior relative strength. This can be through investments in companies generating significant global revenue. American companies that bill a large percentage of their revenue abroad effectively give you exposure to other currencies even while being listed in the United States. It can also be through government bonds from countries with superior fiscal discipline. Germany, Switzerland, some Nordic countries still offer attractive alternatives for part of your fixed income portfolio. The fourth guidance is flexibility and liquidity. In periods of change between monetary regimes, flexibility is more valuable than optimization. This means maintaining a higher percentage of your portfolio in liquid assets than you normally would, cash in different currencies, short-term fixed income instruments in different countries, positions that can be quickly reallocated as conditions change. The goal isn't maximizing short-term return, but preserving capital and keeping options open to seize opportunities that will inevitably arise. Finally, the fifth guidance is continuous financial education. Ignorance is risk, knowledge is protection. Periods of global repricing reward those who understand what's happening and punish those operating based on obsolete assumptions. Invest time understanding global macroeconomics basics, how exchange rates work, how fiscal and monetary policies interact, how global capital flows affect local markets. Not to become a trader or speculator, but to make more informed decisions about how to protect and position your family wealth. Let's be clear about one thing. We're not seeing the end of the American dollar as global reserve currency overnight. What we're seeing is the beginning of a gradual change toward a more multipolar global monetary system. This process will take decades, not years, but the implications begin long before it's complete. For 75 years, since the end of World War II, global economic geography has revolved around the United States. Countries exported to the United States, saved in American dollars, invested in American assets. This created a system where global prosperity depended on American prosperity, and American prosperity depended on the world's willingness to finance the American deficit. Now we're seeing the first signs of different economic geography, regional trade blocs, bilateral agreements that bypass the dollar, central banks coordinating policies without primary reference to Federal Reserve actions. For American investors, this means growth opportunities will increasingly be outside the United States. Countries and regions that historically depended on American demand are now developing robust internal consumer markets. China, India, Southeast Asia, parts of Africa, these regions represent billions of consumers entering the global middle class. And they won't necessarily consume American products or invest in American assets like their counterparts did in past decades. Parallel to geopolitical change, I see technological evolution facilitating alternative monetary systems. Central bank digital currencies, CBDCs, are being developed by dozens of countries. This will allow direct international trade between countries without needing to use dollars as intermediary currency. Alternative payment and international settlement networks are gaining adoption. Blockchain platforms allow international transfers that bypass the traditional dollar-based banking system. These aren't futuristic changes. They're realities being implemented now in 2025. And each one makes your dollar slightly less relevant in the world. For Americans, the transition to a less dollar-centric world will have profound social and political implications. Historically, our ability to print the global reserve currency gave us extraordinary privileges. We could finance massive deficits. We could maintain a standard of living superior to what our productivity alone would justify. We could project military power globally without the fiscal cost normal countries would face. As these privileges diminish, there will be growing pressure for internal adjustments. This might mean greater fiscal discipline. It might mean reduction in global military spending. It might mean greater focus on domestic productivity and international competitiveness. Politically, this will create tensions. Different groups will try to maintain their benefits, while other groups bear the cost of necessary adjustments. But not everything is challenges. Large structural transitions always create enormous opportunities for those who understand them and position themselves appropriately. For investors, a multipolar world offers superior geographic and sectoral diversification. Markets historically considered emerging now represent a growing percentage of global economic growth. For American companies, a more competitive dollar can mean greater competitiveness of American exports. Sectors like manufacturing, agriculture, and technology can benefit significantly. For consumers, pressure on the dollar can accelerate trends like domestic production, local renewable energy, and regional agriculture, all creating jobs and internal economic opportunities. The question is, will you be prepared to seize opportunities, or will you be defending yourself? As any responsible analyst, I recognize the future is uncertain. I see multiple possible scenarios for the dollar situation's evolution. It's possible that current pressures on the dollar are temporary. If the United States can restore fiscal discipline, resolve internal political tensions, and maintain technological leadership, the dollar can stabilize and even recover part of its strength. In that scenario, the protection measures I recommended will function like insurance that fortunately didn't need to be used. You'll have global diversification that still offers positive returns, but the core of your portfolio in American assets will continue being the main wealth source. More likely, in my assessment, is a gradual decline of dollar dominance over 10 to 20 years. Not a collapse, but a transition to a more balanced global monetary system. In this scenario, international diversification becomes not just protection, but alpha source. Countries and regions benefiting from this transition offer superior investment opportunities. Real assets maintain value better than monetary assets. Less likely, but possible, is a confidence crisis forcing rapid and dramatic adjustments. This could be precipitated by an American fiscal crisis, a major geopolitical crisis, or a combination of factors. In this scenario, protections become essential for financial survival. Assets outside the dollar system, precious metals, and liquidity flexibility make the difference between preserving wealth and losing it. The beauty of a strategy based on fundamental principles is that it works regardless of which specific scenario materializes. Geographic and asset diversification. Focus on real assets beyond financial assets. Maintaining flexibility and liquidity. Continuous education and adaptation as conditions evolve. These aren't directional bets, they're risk management principles applying to any uncertainty environment. What you choose to protect today determines what you'll still have tomorrow. If you followed this reasoning this far, I hope one thing is clear. This isn't about pessimism or optimism regarding the United States. I see this as understanding that everything in economics and finance is cyclical. Empires rise and eventually relatively decline. Currencies dominate and then share influence. Systems that seem permanent prove temporary. This isn't tragedy. It's the natural rhythm of human history. The United States will continue being a powerful and innovative economy. But it's natural and healthy for other world regions to develop and assume larger roles in the global economy. For us Americans, the question isn't resisting this change, but navigating it intelligently. This means recognizing that our historical privileges as global reserve currency issuers aren't natural rights, but responsibilities that must be continuously earned through fiscal discipline, political stability, and economic competitiveness. It means understanding that our future prosperity will increasingly depend on our capacity to compete and collaborate in a multipolar world rather than dominate a unipolar world. And it means for each of us individually taking prudent measures to protect our wealth and families during this transition. History teaches us that periods of great global rebalancing are simultaneously times of greatest risk and greatest opportunity. Those who navigate them with wisdom emerge stronger. Those who ignore or resist them are left behind. This isn't distant geopolitics. It's the price at your grocery store, your vacation, your retirement plan. The decline of nearly 11% of the dollar in the first half of 2025 isn't just a number on a screen. It's a signal that we live in one of these historic transition moments. If you understand this, you can prepare for it. And if you prepare for it, you can not only survive the change, but prosper from it. When the center of the system loses credibility, the rest becomes consequence. And when the market understands this, it doesn't wait for you to understand it too. If this made sense, hit the like, not for the algorithm, but because this topic needs to appear for those still on autopilot.